Silver just broke $60. For the first time in years, investors were celebrating. Champagne was practically being poured. And then, in the span of a few short hours, something happened that most people watching the charts completely missed. A number came in. A statement was made. And silver fell right back down. Was this the beginning of something much bigger? Or was it a warning that almost nobody is paying attention to? By the end of this video, you will understand exactly what happened. And more importantly, what it means for your money. Stay with me. Now, before we go any further, I want to ask you for a small favor. If you find value in what we share here, and I have a feeling you do since you're still watching, please take just a moment to hit that subscribe button. It costs you nothing, but it means everything to us. Think of it as shaking hands with an old friend, a way of saying, I'll be back for the next conversation. And I'd love to know, where in the world are you watching this from today? Drop your city or country in the comments below. It always warms my heart to see just how far and wide this community truly reaches. Now, let's get into it. For months, silver had been climbing slowly, patiently, like a runner saving energy for the final stretch. Traders watched it inch closer and closer to a number that everyone in the market had been talking about. $60 an ounce. It sounded almost unreal. Silver had not seen that level in a very long time, and for many investors, it felt like a distant dream rather than something that could actually happen this year. Then it happened. Silver pushed past $60. The price kept climbing until it touched a high of $60.55. For a brief moment, the market felt electric. Analysts who had been cautious for weeks suddenly sounded hopeful. Retail investors who had been stacking silver quietly in the background finally felt like their patience was being rewarded. Even seasoned traders admitted that this was a moment worth paying attention to. $60 is not just a random number. In the world of commodities, round numbers like this carry weight. They act like invisible walls. When a price approaches one of these walls, the market pays close attention. If it breaks through with strength, it often signals that buyers are firmly in control. If it fails, it can suggest the opposite. So when silver broke above $60, many believed this was the moment where silver would finally separate itself from months of uncertainty and begin a new chapter. But markets rarely move in a straight line, and this one was no exception. Just hours after reaching that high, something shifted. The excitement that had built up so quickly began to fade. Silver started slipping, slowly at first, then a little faster. The same traders who had been celebrating minutes earlier were now watching the price fall back toward the levels it had come from. It was as if the market had taken a deep breath of excitement, only to let it out just as fast. This is the part of the story that most casual observers miss. They see the headline, they see the number 60. They assume the story is simple. Silver went up, silver is strong, silver will keep rising. But real market behavior is rarely that simple. A breakout is not proof of strength. It is a test. And in this case, the test revealed something important. The pullback that followed was sharp enough to make people pause and ask questions. Was this just a normal correction after a strong move? Or was it something deeper? Was the market sending a signal that the excitement around silver had gotten ahead of the actual economic reality? For business-minded individuals, this moment offers a valuable lesson. In markets, and often in business itself, the loudest excitement usually comes right before a moment of doubt. When everyone feels confident at the same time, that confidence itself can become a warning sign. Prices that rise too quickly, on too much emotion, often need time to cool down before they can rise again in a healthy way. This is exactly what appeared to be happening with silver. The breakout above $60 was real. The high of $60.55 was real. But the speed of the pullback that followed was just as real, and it raised a simple but important question. Was this euphoria? Or was this the start of a genuine shift in the market? Nobody watching in that moment had a clear answer. The charts showed strength and weakness within the very same hour. The excitement of breaking a major psychological level was still fresh, yet the retreat that followed was already erasing part of the gains. For entrepreneurs and investors watching closely, this was not something to ignore. It was a signal to look deeper. Because in economics, just like in business, the first move rarely tells the whole story. It is what happens right after the celebration that reveals the truth. And in this case, what happened right after silver's historic breakout was about to raise even bigger questions about the forces working quietly behind the scenes. Questions that would lead directly into what happened next. By the time silver had drifted back down from its high, a new kind of tension had entered the market. It was not panic, it was not despair. It was something quieter and in many ways more unsettling. Traders were left staring at their screens trying to figure out whether they had just witnessed a temporary pause or the early signs of a much longer retreat. Silver settled somewhere in the high $50 range, still holding on to a small gain for the day, but far from the excitement of just hours earlier. It was a strange kind of victory, up on paper, yet somehow feeling like a loss. This is one of the more difficult truths about markets that many people never fully learn. A number can rise and still leave everyone feeling uneasy simply because of how it got there. To understand what was really happening, it helped to look beyond silver alone. Gold, silver's more famous cousin, barely moved that day. It inched up slightly, but showed none of the drama silver had just displayed. Platinum and palladium told an even clearer story. Both were falling. Not holding steady, not pausing, falling. This mattered a great deal. When one single metal moves sharply while everything else in its family stays flat or declines, it raises a simple but important question. Was silver moving because of something happening specifically inside the silver market? Or was it swept up briefly in a wave of excitement that had little to do with silver's actual fundamentals? The answer began to reveal itself when looking further back, hours before the breakout even happened. Earlier that day, in markets on the other side of the world, buyers had already stepped in to support silver at a much lower price, down near $56.60. At the time, this looked like quiet strength, a sign that even at lower levels, people still wanted to own silver. But here is where careful observers had to slow down and think differently. A bounce from a low point is not the same as a trend reversal. It is easy to confuse the two, especially when emotions are running high. A bounce simply means buyers showed up at a certain price. It does not mean those same buyers are prepared to keep pushing the price higher no matter what challenges appear next. This distinction is one that separates careful decision makers from those who react purely on emotion. In business, the same principle applies constantly. A single strong sales day does not confirm a new trend. A single new client does not guarantee long-term stability. Real conclusions require patterns, not isolated moments of excitement. As the day wore on, it became clearer that this was not yet a confirmed turning point for silver. It looked more like a pause in a larger story that was still being written. The rally toward $60 had been real. The energy behind it had been real. But energy alone rarely sustains a market for long, especially when larger forces are working quietly in the background. And this is precisely where the story became more serious. Because underneath the short-term price movements, something much bigger was shaping the outcome. Traders were not simply reacting to silver's chart. They were reacting to expectations about interest rates, about central bank decisions, and about a financial environment that made it harder for an asset like silver, something that pays no interest or dividend, to justify holding on to strong gains in a period of uncertainty. This is the part of the story that so many casual observers overlook entirely. They watch the price, they celebrate the highs, they panic at the lows, but they rarely stop to ask what is actually driving those moves beneath the surface. For anyone serious about understanding markets, and especially for those trying to protect or grow their wealth, this is the exact moment where real analysis begins. Silver's pullback was not random. It was not simply bad luck or a coincidence of timing. It was the market quietly telling a story that would only become clearer once the larger economic picture came into full view. And that picture was about to become far more important than anyone watching the daily price chart could have realized. To truly understand why silver pulled back so quickly after its moment of triumph, it was necessary to step away from the charts entirely and look at a much larger picture, one that had little to do with silver itself and everything to do with decisions being made in rooms far away from any trading floor. At the center of this story sat the Federal Reserve. For weeks, traders had been quietly building a belief that the central bank was not finished raising interest rates. This belief did not arrive with a dramatic announcement. It grew slowly, through small comments, through economic reports, through the tone of official statements. And once that belief took hold, it began shaping the way investors treated every asset that did not pay a yield. Silver, unlike a bond or a savings account, offers no interest. It offers no dividend. Its value depends entirely on demand, scarcity, and confidence. In a world where interest rates are rising, holding an asset that produces no income becomes a harder decision to justify. Why hold silver, some investors began to ask, when safer options are suddenly offering better returns simply for waiting? This single shift in thinking carried enormous weight. It explained, in large part, why silver's rally lost momentum so quickly. It was not that silver had suddenly become less valuable. It was that the environment around it had become less forgiving. But there was another layer to this story, one that revealed a strange and uncomfortable contradiction. At the very same time that interest rate expectations were rising, the money supply in the economy was also expanding. More money was being created and circulated even as policymakers spoke about tightening conditions. For business-minded individuals paying close attention, this contradiction mattered deeply. When more money enters an economy while borrowing becomes more expensive, it creates a strange kind of tension. On one hand, expanding money supply usually reduces the value of a currency over time, which historically tends to support assets like silver and gold. On the other hand, rising interest rates tend to pull investors away from those same assets in the short term. Silver, in this moment, was caught directly between these two powerful and opposing forces. This is precisely the kind of complexity that separates a superficial understanding of markets from a genuine one. It is easy to look at a single price movement and form a simple conclusion. It is far harder and far more valuable to understand the deeper forces pulling in different directions at the same time. Adding even more weight to this moment was a quiet but significant shift in how the Federal Reserve's leadership was communicating with the public. For years, investors had grown used to receiving guidance that stretched a full year into the future, giving markets a sense of direction and stability. But recently, that approach had changed. Guidance was now being offered in much shorter windows, often covering only a matter of months rather than a full year ahead. This change might have sounded like a small technical detail to the average observer, but to serious market participants, it meant something far more important. It meant that every new piece of economic data, every job report, every inflation figure would now carry more influence over market direction than before. With less long-term guidance to rely on, traders were forced to react more sharply to each new piece of information as it arrived. For entrepreneurs and decision-makers watching from the outside, this was a critical lesson in how modern economies actually function. Uncertainty was no longer just a background condition. It had become the central feature of the environment itself. And in an environment built on shorter timelines and greater sensitivity to every new report, few assets are more exposed to swings in sentiment than one that offers no yield of its own. Silver was not simply reacting to its own supply and demand story. It was reacting to a much larger struggle between monetary expansion, interest rate policy, and a communication style built for faster, sharper reactions. And that struggle was only just beginning to reveal its next chapter. With the larger economic forces now clear, attention turned back to the charts themselves, where the numbers told their own quiet story. Silver was trading below its short-term moving average, a detail that experienced traders rarely ignore. This single measurement, tracking the average price over recent weeks, acts like a compass. When price sits below it, the short-term direction is generally seen as tilted downward, even if the longer story remains unresolved. Alongside this, another tool told a slightly different tale. A momentum indicator, one that measures whether buying or selling pressure has been pushed to an extreme, was sitting near a low reading. This suggested that selling had already been significant. Sellers had been active, and much of the recent pressure may have already been absorbed. Yet being stretched is not the same as being finished. A market can remain under pressure for longer than logic alone might suggest, especially when larger forces outside the chart are still unresolved. This left silver in a delicate position. Above the current price sat a clear resistance level, a point where sellers had shown up before and could easily show up again. For any real change in sentiment to take hold, silver needed to climb back above this level with conviction. Not just a brief touch, but a genuine reclaiming of that ground. Only then could those still hopeful about silver's next move argue that the recent pullback was simply noise rather than the start of something more serious. Below the current price, a different kind of number carried its own weight. A support level sat not far beneath where silver was trading, a floor that had held firm during previous periods of selling. If that floor gave way, the path lower could open quickly, with the next meaningful stopping point sitting a considerable distance below. For anyone holding silver or considering entering the market, this level represented the line between a healthy pause and a deeper, more troubling decline. But charts alone rarely decide the next chapter. Two upcoming economic reports stood ready to shape silver's path in the days ahead. The first, a report measuring job openings across the economy, was expected to show a noticeable decline compared to the previous month. A weaker number here could suggest the economy was beginning to cool, potentially giving silver some room to breathe. A stronger number, on the other hand, would reinforce the belief that the economy remained resilient enough to handle tighter monetary policy, adding further pressure on non-yielding assets like silver. The second report, arriving just days later, carried even greater weight. A widely watched measure of nationwide hiring was set to be released, alongside data on wages and unemployment. This report has long been considered one of the most influential economic releases of any given month. Should it reveal continued strength in hiring and wages, it would likely reinforce expectations of further tightening, placing renewed pressure on silver's price. A softer reading, however, could shift the narrative entirely, giving buyers a fresh reason to step back in. In this way, silver's next chapter was not going to be written by silver alone. It would be shaped by decisions made in boardrooms, by numbers released in government reports, and by the collective psychology of millions of participants reacting to information almost in real time. The breakout above $60 had captured attention. The pullback that followed had raised questions, but the true test, the one that would determine whether this was a passing moment or the beginning of something larger, was still waiting just ahead.